Hi everyone. Today I want to talk to you about home loans. What is a home loan and the different types of loans that you can actually access? So first of all, what's a home loan? Basically, it is an amount of money that is lent to you in order to allow you to purchase a property. And the organisation that has lent that money to you will typically have a mortgage registered over that property so that if for some reason you can't make the repayments to them, they can then ask you to sell the property so they can recover the money that they have lent to you. So that's what a mortgage is. Now you can get 5 different types of mortgages, or 5 different types of loans is more correct. So the first one is the fixed loan. Now, a fixed home loan is a loan that is given to you for a fixed period of time. And the benefit of a loan that is fixed is that you've got absolute certainty of how much you're going to be repaying back to the bank every month. The disadvantages of a fixed home loan is that if interest rates go down, you still have to pay the amount that you agreed to before the drop in interest rates. But the benefit is that if the rate rises, you aren't paying the increased rate. You are only paying what it was that you agreed to at the time of fixing that loan. One of the big disadvantages, I think, of a fixed loan is the fact that if you, for some reason, have to sell your home quickly, or you decide that you need a bigger home or want to move for whatever reason, if you have a fixed loan, then you are going to be charged some pretty hefty penalties if you sell within that fixed period. So it's great if you want some certainty around how much you're going to pay, and it allows you to budget. Great for first home buyers, in fact, but there are some disadvantages around whether you might want to sell in the future or in the near future. Generally, a fixed home loan is for about, it's usually a 5-year period. The second type of loan you can get is a variable home loan, and variable means exactly that. So the interest rate isn't set, so it will rise and it will fall depending on a couple of factors. Maybe it's the official cash rate set by the Reserve Bank. It might increase or decrease, in which case that can affect your loan. It can either go up or it can go down. Or alternately, the lender that's lending you the money might decide, make a business decision that they need to either increase, generally not decrease, rates for whatever reason, in which case your loan and the amount of interest that you're being charged can change. The great thing about variable home loans is they do offer a lot of flexibility. You can make extra repayments if you want without any penalties. Again, if you need to sell your property, there are no penalties if you are just on a variable home loan. The third type of home loan, which offers a good mix between fixed and variable, is what we call the split loan. So a part of your home loan is fixed, and you've got some certainty over that portion of your home loan, so you know what the interest rate is going to be. And the other portion, maybe it's 30% of your loan or 40% of your entire loan, you keep variable. So that is the bit that moves up and down depending on what interest rates do. So that split home loan offers flexibility that can be very helpful to a lot of people. But again, just keep in mind, if you decide that you need to sell, then you are going to be penalised for breaking the fixed portion of your loan if you do. Then we also have the fourth type of loan that you get is an interest-only loan. And an interest-only loan is very helpful for investors, because basically what it means is you are only paying back the interest on the loan and not the principal. The reason that investors tend to take out an interest-only loan is because the interest is completely tax deductible. So it is a very effective way of keeping repayments low and also having the interest portion deducted from your tax. So a fantastic product for investors. It can also be useful at times for owner-occupiers if you only intend on keeping the loan or keeping the property for a very short period of time, but not recommended for somebody that is planning on keeping the property for 10, 15, 20 years, because ultimately you will end up paying more interest if you don't start to pay down that principal. And the last type of loan that you can get is a line of credit. And effectively what this is, it's like a giant credit card that is taken out against the equity in your home itself. So it means that you can put money into your line of credit and you can take money out of your line of credit up to an agreed limit. And that gives a lot of flexibility. It's particularly popular with business owners and cash flow. So line of credit is not something that I would recommend to somebody who doesn't use it for those kinds of purposes, because it's very easy to end up spending the equity in your home. But it does offer lots of flexibilities for people who need to access cash flow. So they're the 5 types of loans that are available to home buyers today. Thanks for listening, guys.